Welcome to the Retirement Wealth Podcast. We're so glad you're joining us today. If you've ever wondered about the best ways to invest for your retirement, you're in the right place.
Absolutely, Emily. Today, we're diving into a really important topic for anyone looking to secure their financial future: index funds versus mutual funds. This can be a game changer for retirement planning.
Right. It's such a hot topic. A lot of folks are curious about which option might be better for their retirement savings. We'll break down the differences, the benefits, and maybe even some pitfalls to watch out for.
Exactly. We're also going to touch on how these investment vehicles can fit into your overall retirement strategy. It's crucial to understand not just what they are, but how they can work for you.
And we'll share some tips on how to choose the right option based on your financial goals and risk tolerance.
Yes, it's all about finding what aligns with your personal situation,
So whether you're just starting to think about retirement or you're already enjoying it, we've got some valuable insights coming up.
Let's get into it.
First off, David, can you give us a quick overview of what index funds and mutual funds actually are?
Emily, the conversation around index funds versus mutual funds really hits home for a lot of folks right now. With so many changes in the economy, people are looking for ways to secure their retirement.
Absolutely, David. Retirement isn't just about saving money anymore. It's about making those savings last. With inflation being a real concern, people need to think about how their investments can keep pace.
Exactly. Let's take a look at someone like Tom, for instance. He's in his early 60s, planning to retire in just a couple of years. He's been a diligent saver, but with prices rising, he's worried that his savings might not stretch as far as he hoped.
Right, and that's a common fear. Inflation can really eat away at purchasing power. So Tom has been considering switching some of his investments into index funds, which tend to have lower fees and can track the market more closely than actively managed mutual funds.
Yes, and that's a smart move. Index funds often provide a way to capture the broader market's growth while minimizing costs, which is key, especially now. With market volatility, having a strategy that balances risk and returns is essential.
And it's not just about the market. Healthcare costs are skyrocketing too. Many retirees, like Tom, are facing uncertainties about how to cover these expenses. It's crucial to have a solid investment strategy that can help shield against those rising costs.
That's a great point. I've seen retirees who underestimated their healthcare expenses. They thought Medicare would cover most of their needs, but out-of-pocket costs can really add up. If their investments aren't growing at a sufficient rate, they might find themselves in a tough spot.
Exactly. And then there's the emotional side of it. Knowing that your investments are working for you and can withstand inflation and healthcare costs brings a certain peace of mind, doesn't it?
For sure. Financial security can reduce stress and improve overall well-being in retirement. It's about feeling confident that you can enjoy your golden years without constantly worrying about money.
And let's not forget about Social Security changes. Many people are uncertain about when to claim benefits, especially with the potential for adjustments in the future. Having a solid investment plan can help bridge any gaps in income.
Right, Emily. For some folks, waiting to claim Social Security can be beneficial, but that means they need to have other income sources to rely on during that waiting period. That's where a balanced portfolio, potentially including index funds, can play a significant role.
Definitely. And speaking of income sources, many people want to leave a legacy for their families. They might feel that mutual funds, with higher fees and management costs, could eat into what they plan to pass on.
That's true. Index funds can be much more tax efficient as well. If you're not continuously buying and selling investments, you're avoiding capital gains taxes that can be incurred with mutual funds. This can be a big deal for someone looking to leave a financial footprint for their children or grandchildren.
Right, and it's important to think about how taxes will affect their overall retirement plan. A tax-efficient strategy can mean more money in their pocket and a greater legacy to pass down.
And let's not overlook the current economic trends. Interest rates are fluctuating, and we're seeing a lot of uncertainty in various sectors. This makes it even more crucial for retirees to be adaptable and consider investment options that can provide stability.
Exactly. Having a mix of low-cost index funds can help provide that stability. Plus, they're easier to manage, especially for those who might feel overwhelmed by the complexities of mutual funds.
Right, and it's not just about the numbers. There's an emotional aspect too. Feeling like you're in control of your financial future can be incredibly empowering.
Yes, and that empowerment can lead to better decision-making, which is vital as retirement approaches.
So, as we transition into discussing some core strategies, it's clear that understanding the differences between index funds and mutual funds isn't just about investment performance. It's about ensuring financial security in all aspects of retirement life.
Absolutely, David. Let's dive into those strategies and help our listeners make the best choices for their retirement journey.
So, Emily, when we're looking at index funds versus mutual funds, it's really important to think about, the overall strategy for retirement. One of the core strategies I like to emphasize is diversification.
Absolutely, David. Diversification helps reduce risk, right? So it's not about putting all your eggs in one basket.
Exactly. And with index funds, you can achieve diversification more easily because they track entire market indices, like the S&P 500. For example, if you invest in an S&P 500 index fund, you're essentially investing in 500 of the largest companies in the U.S. That's a pretty broad exposure.
Yeah, that sounds like a smart way to spread out the risk. How does that compare to mutual funds in terms of fees, though?
Good question. Generally, index funds have lower fees compared to actively managed mutual funds. Since index funds are passively managed, they don't require a team of analysts to pick stocks, which can lead to lower expense ratios. For instance, you might see an index fund with an expense ratio of around 0.1% versus a mutual fund that could be 1% or more.
Wow, that's a significant difference. Over time, those fees can really eat into your returns, can't they?
Yes, they can. To put it into perspective, if you're investing $100,000 with a 7% annual return over 30 years, a 1% fee could cost you over $300,000 in lost gains. So keeping fees low is really key.
That's a compelling point. Now, when it comes to tax-advantaged accounts like 401ks or IRAs, do you recommend using index funds there as well?
Absolutely. In fact, I often suggest using index funds in those accounts because the tax advantages can enhance your returns even further. For example, with a Roth IRA, your money grows tax-free, and withdrawals in retirement are tax-free too. So having a low-cost index fund can really maximize those benefits.
Right, and I guess that aligns with the long-term growth strategy you often speak about.
Exactly. Speaking of long-term, another strategy I like to talk about is the 4% rule for withdrawals. It's a guideline that suggests you can withdraw 4% of your retirement savings each year without running out of money for about 30 years.
That's a pretty popular rule. But I've heard some people say that it might need to be adjusted based on current market conditions. What's your take on that?
Yeah, you're right. The 4% rule isn't a one-size-fits-all solution. For instance, if you're retiring in a bear market, or if life expectancy is increasing, you might want to consider a more conservative withdrawal rate, like 3.5% instead.
It's all about being flexible, huh?
Exactly, and that's where having a solid withdrawal strategy comes into play. Another approach is the bucket strategy, where you divide your assets into different buckets based on when you'll need to access them. For example, you might have a bucket for short-term needs filled with cash and bonds, and a long-term bucket invested in stocks.
So, that way, your immediate needs are secure while your longer-term investments can grow?
Right. It helps you weather market volatility. If the market is down, you're not forced to sell your stocks at a loss because you have that cash or bond bucket to fall back on.
That makes so much sense. Now, let's pivot a bit to real estate. How does that fit into a retirement strategy?
Real estate can be a great addition to a retirement portfolio. It offers diversification and potential income through rental properties. Plus, if you own your home outright, that can reduce your living expenses in retirement.
And I imagine there are tax benefits as well, right?
Yes, definitely. For instance, when you sell your primary residence, you can exclude up to $250,000 in capital gains for single filers and $500,000 for married couples, provided you've lived there for at least 2 of the last 5 years. That's a big advantage.
Wow, that's a nice perk. What about annuities? Are they something you'd recommend for retirement income?
Annuities can be a useful tool for some retirees. especially for those looking for steady income. They can provide a guaranteed income stream for life, which can help cover essential expenses. But it's crucial to understand the fees and terms associated with them, since they can be complex.
Right, and I imagine it's best to weigh the pros and cons before diving into them.
Exactly. It's all about understanding your unique situation and how each option fits into your overall plan.
Speaking of unique situations, let's talk about Social Security. How can retirees optimize their benefits?
Great topic. One key strategy is to delay claiming Social Security benefits. For every year you delay past your full retirement age, your benefits can increase by about 8% until age 70. So, if you can afford to wait, it might be worth it.
Wow, that's a significant boost. But what if someone needs the income earlier?
If you need to take it earlier, that's okay too. Just be aware that your monthly benefit will be reduced. It's all about balancing your immediate needs with long-term gains.
And having a solid understanding of your expenses can really help in that decision, right?
Absolutely. Knowing what you'll need for living expenses can guide that decision. It's also crucial to think about your asset allocation. A common rule of thumb is the 70-30 portfolio, 70% in stocks and 30% in bonds, adjusting based on your risk tolerance.
That's a good guideline. And I imagine as you get closer to retirement, you might want to shift that allocation to be more conservative.
Exactly. As you approach retirement, you typically want to reduce risk to preserve your capital. So gradually shifting towards bonds or more stable investments makes sense.
It's all about finding that balance. But what are some common pitfalls people should avoid when planning for retirement?
That's a crucial part of the conversation. One major pitfall is underestimating healthcare costs. Many people don't realize how expensive healthcare can be in retirement. Another is not having a plan for long-term care, which can be a huge financial burden.
That's a scary thought. And I suppose not having a withdrawal strategy can lead to running out of money too.
Exactly. Not having a clear plan can lead to financial stress later on. It's all about being proactive and informed in your retirement planning. So, Emily, one of the most common pitfalls I see with retirement planning is the sequence of returns risk. You know, it's not just about how much you save, but when you actually experience gains and losses.
Right, that makes sense. Like, if the market takes a downturn right when you're withdrawing funds, it can really affect your portfolio, can it?
Exactly. I had a client once, let's call him Tom. He retired in 2007, just before the financial crisis. He was relying on his investments to provide income and, well, the market dropped significantly right after he retired. His portfolio took a hit, and he had to adjust his lifestyle, which was really tough for him.
Wow, that must have been stressful. So, what could he have done differently?
A great question. Tom could have considered a more balanced withdrawal strategy, maybe keeping a cash reserve or using fixed income investments during downturns. It's really about having a plan that allows for flexibility, you know?
That makes a lot of sense. And I guess another common mistake is not considering the tax implications when withdrawing funds, right?
Absolutely. A lot of retirees focus on the gross amount they need, but forget about taxes. For example, I had a couple, let's call them Sarah and Mike. They were withdrawing from their traditional IRAs without thinking about how it would affect their tax bracket. They ended up paying way more in taxes than they anticipated, which cut into their budget.
That sounds frustrating. So how can people avoid that pitfall?
Well, it's important to have a tax-efficient withdrawal strategy. Maybe mix it up by taking from taxable, tax-deferred, and tax-free accounts. And consulting a tax professional can be really beneficial too.
Right, so they can help navigate those complexities. Another thing I often hear about is underestimating healthcare costs, especially as we age. That can be a huge factor, can it?
Yes, it really can. I remember a client, let's call her Linda. She was really focused on her travel plans in retirement and didn't factor in healthcare costs. When she turned 65, she suddenly had to deal with unexpected medical expenses that weren't covered by Medicare.
Oh no! Did that put a strain on her plans?
It did. She had to adjust her budget significantly, which cut into her travel funds. It's essential for folks to do a deep dive into healthcare costs and even consider long-term care insurance. It's better to plan for those expenses up front, rather than be caught off guard later.
That's a great tip. Speaking of planning, what about asset allocation? I've heard people can make mistakes there too.
Definitely. Many retirees are either too aggressive or too conservative with their asset allocation. I had a client, let's call him Jim, who was still heavily invested in stocks even in his late 60s. When the market dipped, his portfolio lost value, and he felt compelled to sell, locking in those losses.
Oh, wow, that's tough. So what's the right approach to asset allocation for retirees?
It really comes down to understanding your risk tolerance and time horizon. Generally, as you age, you want to shift towards more conservative investments. A diversified portfolio that includes bonds, equities, and maybe some alternative investments can help mitigate risk.
That makes sense. And I know Social Security claiming can be another area where people make mistakes. I've heard that claiming too early can lead to reduced benefits, right?
Yes, exactly. I worked with a couple, let's name them Carol and Dave. They claimed Social Security at 62 because they thought they'd maximize their benefits. But they didn't realize that by claiming early, they were locking in lower payments for life.
That's a real eye-opener. What should people consider when deciding when to claim?
It's all about your personal situation, your health, your financial needs, and if you have other sources of retirement income. Delaying benefits can significantly increase your monthly payments, which can really help in the long run.
It sounds like a lot of factors to juggle. Are there any red flags that people should look out for to avoid these mistakes?
Absolutely. One red flag is if someone is overly optimistic about market returns. If they're planning based on unrealistic growth rates, that's a warning sign. Another is a lack of a comprehensive plan. If someone doesn't have a clear strategy for withdrawals, taxes, or healthcare, they're setting themselves up for potential pitfalls.
Those are good points. So it sounds like having a solid plan and being realistic about expectations is crucial.
Definitely. And staying flexible is key. Life changes, and so do markets. Regularly reviewing and adjusting your plan can help you stay on track. It's also a good idea to have an advisor you trust to help navigate these complexities.
That makes a lot of sense, David. So if someone realizes they've made one of these mistakes, what are the next steps they can take to recover or avoid future issues?
First, it's important to assess your current situation. Take a close look at your investments, your withdrawal strategy, and your overall financial plan. Then, consider speaking with a financial advisor to help identify gaps and create a more robust strategy moving forward.
That sounds like a proactive approach. I think many people might feel overwhelmed, but taking those small steps can really make a difference.
Exactly. It's about empowerment. Retirement planning doesn't have to be scary. It can be an exciting journey if you approach it with the right mindset and tools.
I love that perspective. It really emphasizes that planning is an ongoing process rather than a one-time event.
Absolutely. And the more informed you are, the better decisions you'll make, which can lead to a more fulfilling retirement.
Thanks, David. I think our listeners will find this discussion incredibly helpful as they navigate their retirement planning.
I hope so, Emily. It's all about making informed choices and enjoying the journey. So let's dive into some immediate steps that listeners can take right now to really get their retirement planning on track.
Absolutely. I think it's so important to have actionable steps. What's the first thing you'd recommend?
Well, one of the best things you can do is start with a retirement calculator. Websites like Vanguard, Fidelity, or Schwab offer these tools for free. You just plug in your numbers, and they can help you visualize where you stand.
That's a great starting point. It can be pretty eye-opening to see the projections, right?
Exactly. And once you have a sense of where you are, you can run different scenarios to see how adjustments might impact your retirement. You know, like if you bump up your contributions or change your investment strategy.
That makes a lot of sense. And speaking of contributions, how often should folks be reviewing their portfolios?
I usually suggest reviewing it quarterly, just a simple check-in to ensure everything's aligned with your goals. It doesn't have to be a deep dive every time, just a quick look to see if anything needs adjusting.
That sounds manageable. And what about tax implications? That can get tricky, right?
Oh, definitely. It's essential to understand the tax implications of your investments, especially as you approach retirement. I recommend checking out ssa.gov for Social Security estimates and to see how that fits into your overall plan.
That's a great resource. And I know tax software can help with projections as well.
Yeah, using tax software, like TurboTax or H&R Block, can give you insights into how your retirement withdrawals might affect your tax situation. Understanding this can help you strategize your withdrawals down the line.
It's all about planning ahead, isn't it?
Exactly. And if anyone feels overwhelmed, I encourage them to consider financial planning apps. There are so many user-friendly tools out there that can help you track your expenses, savings, and investments in one place.
That sounds super convenient. Are there any specific apps you recommend?
Well, I've heard good things about Personal Capital and Mint. They both offer budgeting tools and investment tracking, so you can keep an eye on your overall financial health.
Nice. And for those who want to dive deeper into learning, are there any books or podcasts you'd suggest?
Absolutely. I always recommend The Simple Path to Wealth by J.L. Collins. It's straightforward and really encourages a solid investment strategy. As for podcasts, Choosify is fantastic for actionable tips on financial independence.
Those are great suggestions. It's so encouraging to see how many resources are out there.
Right? And remember, it's never too late to improve your plan. Even small habits can make a big difference, like setting aside a few minutes each month to run retirement projections, or just to review your investment choices.
That's such a good point. Small steps can lead to significant changes over time.
Exactly. And think about setting up automatic contributions to your retirement accounts if you haven't already. It's a way to ensure you're consistently saving without even having to think about it.
Automating savings can definitely take the pressure off. It's like putting your retirement on autopilot.
Yes, and as you get more comfortable, you can adjust those contributions as needed. The key is to start and keep moving forward.
So with all these practical steps, it really sounds like listeners have a lot of ways to take control of their retirement planning.
Definitely. And I hope everyone feels empowered to take that next step. So those are some practical first steps. Now let's bring this all together. So as we wrap up our discussion on index funds versus mutual funds, there are a few key takeaways to remember, right?
Absolutely, David. First off, we talked about how index funds generally have lower fees compared to mutual funds, which can really add up over time.
Yeah, and those lower fees mean more of your money is working for you, which is crucial as you build your retirement nest egg.
Exactly. Then we touched on the importance of diversification. Index funds often provide broad market exposure, which helps spread out risk, while mutual funds can be more focused, sometimes leading to higher volatility.
Right, and speaking of volatility, it's important to consider your risk tolerance. Index funds might be a better fit for those who prefer a more hands-off approach, while mutual funds can offer actively managed strategies for those who want more guidance.
And let's not forget about performance consistency. Historically, index funds have outperformed many actively managed mutual funds over the long term.
That's a big one. It really emphasizes the idea of staying in the market rather than trying to time it.
Absolutely. So as you think about building and protecting your retirement wealth, remember that a well-informed and strategic approach can make all the difference. It's about finding what suits you best.
And don't forget, it's never too late to start planning or adjusting your strategy.
For sure. If you enjoyed today's episode, please take a moment to like, subscribe, and maybe even drop a comment about your biggest takeaway or any questions you might have.
And if you know someone who's planning for retirement or already in it, share this episode with them. It might just spark a conversation that helps them out.
Next time, we'll dive into the differences between Roth and traditional accounts for tax savings.
That should be an exciting topic.
Definitely. So until then, take care and keep focusing on your retirement goals.
Yes, we'll see you next time.